So we can start officially. It is, oh my goodness, can you believe it? It's the third Wednesday in February already. We're like racing into 2024. And how many people are feeling like it's going to be a very interesting year? We kind of, yeah, we're kind of feeling that, right? Yeah, I had a couple of I've had many interesting conversations over the last few weeks. Interest rates, our CMHC mortgage on Crescent, after our application went into CMHC last June. I know you guys have been listening to me just drone on and on about this. We finally have our commitment letter. We'll finally have a mortgage in place on our Crescent property, hopefully within 3 weeks. And then I think I can kind of go back to somewhat of a normal life and catch up on all kinds of other things that I'm behind on, because that's been taking so much time. But yeah, lots of people are saying it's going to be a very interesting year. One group is saying, oh, hey, the market is really picking up. And another market is saying it's crickets out here. There's nothing happening. So, and those are like, you know, in the same city. So it's just really interesting how everybody's interpreting things. And so, yeah, so it's going to be a very interesting year. There seem to be a lot of tax changes. Even with me being down here in Mexico, I am seeing, did you know this? And were you aware of this? And so when we talked about this quite a while ago with Karen and Gabby, we thought this would be a really good time to have this conversation, because we knew there were going to be some changes. And, you know, we'll probably need to do another one of these not too far in the distant future, because there's going to be changes to Airbnb rules. There's still so many things coming. I mean, every day the government talks about a new policy or a change or new funding or a break that they're giving on people who are developing or this or that. So it's really hard to keep up. And so it's great that we've got a great accounting firm who can come on board and help us out. And I know a few of our WREN members have already started working with Chan Nosad and Boats. And so we're excited that Gabby from Chan Nosad Boats is here tonight, and she's going to give us a little bit of a tax update on what's going on. So if you've got some questions, it might not be a bad idea to just pop those in the chat, so that we can just kind of get prepared and just see if any of those are things that, you know, we can answer tonight, or if Gabby or Karen needs to go and head off and get those answers from somewhere else. Yeah, this is going to be fun. So just to give you a little bit of background, Karen Stewart, who is on the call with us tonight, Karen and I met probably, I think it was just over a year ago, Karen, through our friend Dawn Cameron. So of course, many of you have been, you came up on the bus tour that we did to Dawn's showroom, and we're going to probably do another one this spring. There were so many people who said we want to do that again, and people who didn't get to go. So we're going to probably do another one. We're just working out some dates. So Karen was referred to me through Dawn. And we just, you know, of course, as we do, we started talking about women and building wealth and building legacy and supporting each other. And so Karen and her accounting firm that she's partners with came on board, and she offered up Gabby to be the spokesperson and do a presentation. And so we're always excited when more than one person from an organization gets involved, because it just, there's more depth, there's, you know, more people, and it just gives us, you know, people that we like to work with, and you get to see who's part of their team and who's working on your accounting folders and files if it's going to their office. And so I'm super grateful that they're here tonight, and thank you for answering some of our accounting burning questions so that we can get ready and get accounting stuff done. So Gabby, do you have a slide presentation that you want to share?
I do, yeah. If I could
Yes.
I'll jump in and share my screen.
I will give you
Oh, thank you.
co-hosting capability. And so while you're getting your screen warmed up, we'll just wait for that, and then we'll turn it over to you. And Gabby, if there's anything else that you want to tell us about yourself, or Karen, if you want to tell us anything about what's going on with Chan Knows That Boats before Gabby jumps in, that's great too. But no pressure, whatever everybody wants to do. We're super informal here, so I'm drinking wine. So there,
Yeah.
you can barely see it.
I think you have something a good idea there. All I have is boring coffee, but I like your idea better.
Yeah.
Yeah, our firm is Chan Knows That Boats. We've been in business since 1983, so a really, really long time. And I started with a firm when I was 19 years old, and so I'm 50 now. So I've been there, grew up there basically. Spent my whole life there, and mentored by, some of the best accountants there is, in my opinion. And personally, I've been involved in various business ventures that included real estate. We built and sold spec homes. We built and rented homes. So I've been a landlord, been a property owner. Of course, I'm a business owner in Chan Knows That Boats. Same as Gabby. Gabby is joined the firm in January 2023. So we're super happy to have young, new energy on board, and she's really good at these kinds of presentations and that. So I'm like, please do it. I love that. So yeah, I guess I'll turn it over to Gabby to tell you about herself and get the meeting started.
Awesome.
Yeah, thanks for the intro, Karen. I think you've kind of summarized it pretty well. Like she said, I'm a partner at CNB as well. So hopefully I can shed some light on some of your burning questions and give you a bit of an idea of how you can start preparing for tax season here. I'll summarize what I'm going over, but I'll introduce myself a little bit more first here. I think I've met some of you at Don Cameron's showroom when you were up in our neck of the woods. I'm based out of Campbell River, and along with Karen. Our office we have two offices, one in Campbell River and one in Courtenay. So mostly presence in the upper half of the island, but we work with clients all over the island, on the mainland, all the way up to Haida Gwaii, and even some clients in different provinces. So we're very lucky to be working kind of all over Canada now. And yeah, it's lovely to meet you all. So I'll dive into my presentation, assuming everyone can see my screen here with a nice waterfall.
Looks good.
Okay, thank you. All right. So as I mentioned, I'll be taking you through a bit of a tax season update, giving you an idea of how you can start preparing for tax season, some of the tax changes that you might have heard about, giving you a bit of an idea of what you should be aware of in terms of those tax changes, and a bit of a focus on real estate, given the nature of this group. Going through the new trust reporting requirements, which might be applicable to some of you. Underused housing tax, which also might be applicable for some of you. And finally, a bit of an outline of the BC speculation tax. So preparing for tax season, and I've included some, throughout the presentation, some pictures of our beautiful area here up in Campbell River and the Comox Valley. So if you're from our area, you'll hopefully recognize some of these, and if not, maybe it'll encourage you to come visit us at our office and see some of the beautiful regions up here. So touching on important dates for this tax season, RRSPs, a bit of a document roundup for what you should be starting to assemble with you, well, as your accountant is starting to ask you for these documents. And finally, the sale of property. So some of the important dates for this tax season. The first is February 29th, which is coming up next week. I believe it's next Thursday. That's the deadline to contribute to your RRSP. So you still have time to make an RRSP contribution if you haven't already, if you're a little bit worried about if you've got taxes payable for 2023 and you want to reduce that tax, you can still do that. The T-slip filing deadline is also February 29th. So this might be applicable for you if you have a corporation and you've taken money out of that corporation, or you pay yourself a wage from the corporation. Hopefully your accountant is working on that. It might be Karen. For March 31st is our T3 filing deadline, and this will be a little bit more clear once I dive into the new trust reporting requirements that are applicable for this year. April 30th is the deadline to file your taxes, and June 15th is the deadline to file your taxes if you or your spouse are self-employed. You have a little bit more time. But it's important to note, if you are self-employed, and you have a balance owing on your taxes, you'll still have to pay that balance owing by April 30th. In terms of RRSPs, as I said, there's still some time to contribute. You have until next Thursday, February 29th. If you're not too sure how much room you have in your RRSP to contribute, you can check that on your notices of assessment that you should have received from the CRA after your 2022 taxes were filed. And you can also check that on CRA online if you have access to your online account, or alternatively, your accountant might have access to your online account and can tell you what your contribution limit is if you're not too sure. And RRSP contributions are a really great way to reduce your net income for tax purposes. And the purpose of that is to reduce your taxes payable, of course. So the way that it works is whatever you contribute to your RRSP will get reduced in that amount from your net income. So if your total income was 100 grand and you made a $20,000 RRSP contribution, your income that would be taxed would be $80,000. So the benefit of this is that you pay less tax in the current year. And then in the future, when you retire, and in most of the time you're in a lower tax bracket because you're either on a pension income or CPP and that kind of thing, you'll be paying less tax at that time. So your tax rate will be lower, and it'll make more sense at that time to take those RSPs out and be taxed on that money. In terms of documents to prepare for tax season this year, the most common documents that we generally request from our clients are T-slips. So of course your T4, your T5. You might not have received that yet, with the deadline being next week, although some of you might already have those. RSP contribution receipts. These you should have received either in the mail from your bank or your investment broker when you made the RSP contribution, or you can also download these usually from your bank or from your investment advisor's website. Medical receipts. These, hopefully you've been keeping them throughout the year, but if you haven't, if you use the same providers, like a pharmacy for prescriptions, you can always ask them to provide you with a summary of all of your prescriptions for the year. And that's a super easy and clean way to just get a summary that shows all of your expenses, all of your medical expenses for the year. And then you don't have to calculate all of your receipts together and bundle up a whole bunch of papers. If you had tuition, or if you had kids that had tuition that you'll be claiming, you'll need the T2202, which is provided by the university or their education, their place that they're getting their education, and they should be able to download this online. Childcare receipts, if you have kids and they were either taken care of at a daycare center or a nanny or a babysitter. And then investment statements and slips. These sometimes are not provided until later, sometimes not until late March. So that's something to be aware of if you do have investment accounts. Sometimes you have to wait a little bit later for those. And then the last one that's really common that we see, and likely very applicable for this group, is rental income and expenses. So hopefully you've gone and figured out what your rental income was for each individual rental property, as well as all of your expenses for those. And I'll dive a little bit deeper into that as well. Again, for preparing for tax season, the sale of property is one that we see very often with our clients, whether it's the sale of their principal residence or the sale of a rental property. You need to be thinking about whether you sold a property in 2023, because either way, you'll need to be reporting that on your personal tax return. The tax consequences of the sale of that property will depend on the type of property that it was. So of course, there's the first situation where it's your principal residence, the house that you lived in. or perhaps it was a rental property. And then the last situation could be where you had a property that was built to sell or that you flipped. And the tax consequences, as I mentioned, are different for each of those three scenarios. So for your principal residence, this is the one of the most common scenarios that we see, and this is where you sell a property that was your principal residence, and you don't have to pay any tax on the sale of that principal residence, assuming you're claiming the principal residence exemption for all of the years that you lived in that house. For it to be considered your principal residence, the property has to have been inhabited by you at some time during the year. So you don't have to live there all the time. If you have multiple properties, you can designate, say you have a cabin, you could designate that as your principal residence if you are inhabiting it at some point during the year. And it's always good to have that conversation with your accountant to see whether it makes sense to use your principal residence exemption for the property that you sold, if it's eligible. And then just to note, land can only be considered part of your principal residence up to 1.24 acres. So if you have a large property and that's your principal residence, only a small portion of the land is included in that exemption. You do have to, despite it not being taxable, you do have to report the sale of your principal residence on your personal tax return. There's no tax, but the government collects that information and you are required to report that. So there's certain things your accountant will need if you did sell your principal residence, including the original cost, the proceeds of the sale, the year that it was purchased, and then the years that you're designating it as your principal residence. And then if you used part of your home to earn income, say you had a suite in your basement or a suite on your property, the part of the gain that relates, if there is a gain, the part of the gain that relates to the income producing part of your home may not qualify for the principal residence exemption and be taxable. So that is something to discuss with your accountant as well if you did rent out a portion of your home. So if you did buy the property with the main intention of selling it, you'll owe tax on the resulting gain or profit. So this would be a situation where it's not your principal residence and you bought the home with your plan was to sell it and make a profit. In some situations, the gain on the sale of the property might be considered business income instead of a capital gain. So depending on what your plan was and what your intention was for the property, the tax outcome will depend on, like I said, what your intention was. So there's an important distinction here because business income is taxed differently from capital gains. Business income is taxed at 100% tax rate, at your full tax rate, whereas capital gains are taxed at 50%. So there's a bit of a tax break when it's a capital gain versus if it's considered to be business income. And I'll dive into when those two scenarios apply. So in the case where you're buying to build and sell, this usually involves someone who buys some land and then builds a property and sells it. It would also qualify if you purchased a house and then significantly renovated it or demolished and replaced with a new build. In these scenarios, the profit that you earned when you built and sold the house is considered business income. So like I said, it's fully taxed. You don't have the capital gains 50% tax rate. And then even if you lived in the property while you're making those improvements, this doesn't automatically qualify you for the principal residence exemption because of your intention to buy and sell for the profit. So something that's definitely important to be aware of if you're someone who is hoping to use that principal residence exemption and by living in the house despite your plan to sell it. So in situations where you buy a property and your intention is to earn rental income from that property, you will have, if you sell that property, the capital gain will be taxed as a capital gain. So it won't be business income if you have a rental property, and you'll get that 50% tax break. So when you're preparing for tax season and thinking about your rental income, there's certain things that you'll want to start preparing to bring to your accountant. The first is determining what your gross rental revenue is, as well as your rental expenses. You'll need to know what your net rental revenue was for the year, because your net revenue or your net income is what will be taxed on your tax return. Expense types that you have, they might be capital in nature and they might be current expenses. Capital expenses are those that provide benefit that lasts over several years and might extend the useful life of the property. So generally, this is considered when you are improving the property beyond its original condition. Current expenses are those that provide only a short-term benefit or ordinary maintenance. So those are current expenses are directly deductible in the year that they're incurred, whereas capital expenses are what's called capitalized and then depreciated over time. So as a tip, you'll want to total up your rental income and expense summary for your accountant, and that'll save you some money on your tax fees. Instead of bringing them a big pile of receipts, it'll take them less time to prepare your taxes. So if you have the time to go through and summarize your own rental income and expenses in a summary for your accountant, it's a good idea if you do want to save on that tax bill. So some examples of current expenses are insurance, interest on borrowed money, office expenses. You might have office supplies to help you prepare that rental income summary. Professional fees, so that could include your accountant's fees or legal fees. You might have property management fees, regular repair and maintenance, property taxes, utilities, or strata fees. So there's certain times where you have a property and there's a change in use in that property. So a lot of the time what we'll see is an individual who lives in a property and it's their principal residence. And at some point in time, they'll decide that they're going to move out of that property and turn it into a rental property. It's important to know that when this happens, there is a taxable event, and you should make your accountant aware that you've changed the use of that property. Because from the CRA's perspective, you have now changed the use of your property and you're deemed to have disposed of it. So if it was originally your principal residence and it changes into a rental property, you'll still have to report that on your tax return because you're deemed to have disposed of the property in the year that you changed its use. If it was your principal residence, like I said previously, you won't owe any tax on the change in use of that property because of the principal residence exemption. But in certain scenarios where a property was initially a rental and then becomes your principal residence, you might have a capital gain in the year that you switched uses. And so it's very important to be aware that changing the use of a property might result in tax if it was originally a rental property, and it does have to be reported on your tax return. So that's the end of my slides on preparing for tax season and some common things to be aware of to bring to your accountant's attention if anything applied to you. I'll go through now some of the tax changes that are important for 2023 and are the most common ones that we're expecting our clients to see and will maybe be applicable for you. The first is the home office deduction for employees. So this is one that we saw many clients take advantage of during the years of COVID. It was introduced by the CRA in 2020 because of COVID-19 and the many employees that were working from home. And it was in place from 2020 through 2022. The CRA allowed employees who were working from home to have a $2 a day working from home deduction up to a maximum of $400 in 2020 and $500 in 2021 and 2022. Employees didn't have to retain any supporting documentation to claim this deduction, and they didn't need their employers to sign any forms for it. Now for 2023 and going forward, that $2 a day claim is no longer available. So if you did work from home, you are still able to claim a working from home exemption if you meet certain criteria. And you just can't use that $2 a day simplified claim anymore. You'll have to use the detailed method to calculate your working from home deduction. So under the detailed method, it's, as it sounds, it's using the actual detail of what your costs were for your home. And you do have to get your employer to sign a T2200 form. So this form confirms that you were required to work from home at least 50% of the time, and that you did in fact work from home. Some of the expenses that can be claimed as part of your home office, if this does apply to you, include utilities, internet, rent, maintenance specifically for your office area. And then if you're a commission employee, you can also claim property taxes and home insurance. The next tax change that will be important to note and that clients often ask us about are the tax rates. So the tax brackets are updated annually for inflation. And I've outlined the combined marginal tax rates for British Columbia here in this slide, and I won't read through all of them, but you can have a look at the columns on the left in each of these tables to see how the tax brackets changed. So you can see that each of the tax brackets jumped up a little bit. So the first at lowest tax bracket, the maximum salary was 43,000 approximately, and jumped up to a little over 45,000 in 2023. So if you didn't get a raise in 2023, you might benefit from this, but if you did receive a raise, you'll likely be staying in that same tax bracket that you were previously. The next tax change to be aware of and likely applicable for this group is the principal residence exemption. There's some anti-flipping rules that have been introduced. So beginning January 1st, 2023, any gain from the sale of a housing unit that was not owned for 365 consecutive days is deemed to be business income and not a capital gain. So these rules were introduced to try to tackle people that were moving into houses and flipping them in a quick succession and trying to use that principal residence exemption to avoid tax. There are certain exemptions that exist for people if they did sell a house that was their principal residence within 365 days of purchasing it. Most of these relate to life events, so the death of a taxpayer or a related person. If you joined household, so if you got married or had a child or adopted, breakdown of marriage, if you lived apart for 90 days, if there's a threat to your personal safety, so mostly domestic violence, if there's serious disability or illness of the owner, or if you had to move 40 kilometers closer to new work or school. So if someone did buy a house and had to sell it for any of these reasons, they won't be subject to the anti-flipping rules because they'll meet one of these exemption criteria. And just a few more exemptions on the anti-flipping rules. Involuntary termination of employment. So if you lost your job and had to sell your house, the insolvency of a taxpayer, so bankruptcy, or the destruction of the property, such as a fire. Now I'll dive into the new trust filing requirements. You might have heard about these, maybe not. I know most clients that we've talked to about these new trust filing requirements have been quite surprised at how they might apply to them. So hopefully these don't apply to you, but if they do, then we'll be glad that we brought it to your attention. So what is trust filing requirements and what are the types of tax returns that are filed in Canada? You'll likely hear your accountant refer to T1s. That's your personal tax return. There's also T2s. Those are corporate tax returns. And those two types of tax returns are the ones that we see in our office every single day, very common. And then finally, there's T3s. And these are trust tax returns for trusts and estates specifically. And in general, up until now, they've been considered less common and less applicable to the vast majority of people. So prior to recent legislative changes to trust filings, there's only certain trusts that had to file a T3 trust return. And these were, and I've just summarized them briefly, they're called inter vivos trusts. So those were Family trusts, alter ego trusts, real estate investment trusts, so REITs, those had to file T3s, as well as testamentary trusts. And previously, certain trust arrangements did not have to file a tax return, may now have to file. So these new reporting requirements apply to arrangements that are usually referred to as bare trust arrangements. And bare trust arrangements, I'll explain a little bit further, but it's when legal ownership differs from beneficial ownership for an asset. So in a bare trust arrangement, this refers to any trust arrangements under which the trustee can reasonably be considered to act as an agent for all beneficiaries under the trust. And the new reporting requirements applies to trust years ending after December 30th, 2023. So for the 2023 tax year. And the due date of filing T3s is 90 days after the trust year end. So the due date is March 30th, 2024, so the end of next month. So what is a bare trust arrangement? I think the general majority of people might not understand what a bare trust arrangement was. I know prior to becoming an accountant, I likely wouldn't have. But some common ones that you might see would be situations where, for example, parents are putting their name on the title of their child's first home for the purpose of helping that child get a mortgage or for lending purposes. So in this situation, there is a bare trust arrangement. The beneficial owner is the child, and one of the legal owners is a parent. So in that situation, we have a bare trust arrangement, and you might have to file a T3. A few other common arrangements are parents or grandparents that are opening a bank account in the name of their children or grandchildren. Legal title of property being transferred to a child for probate planning purposes. The beneficial ownership of assets transferred to a new corporation where legal title remains with the individuals. So for example, a common one that we might see is where there's a vehicle that is shown as an asset of a corporation, but the title remains with the individual. So the ICBC has the individual on title and not the corporation. Property management companies that hold funds in trust for individuals or strata corporations also might qualify as a bare trust arrangement. And then finally, lawyers who have specific trust accounts for their clients. And just a note that general trust accounts that are required to be maintained by lawyers don't fall under this rule. So what is a T3 return and who has to file it? If there's a bare trust arrangement, such as any of the ones that I just provided as examples, there is now a T3 filing requirement. So there's a good chance that there won't actually be any taxes owing if one of these situations exists, but there's still a need to file an information return within that T3 and provide it to the CRA. Original bare trust agreements need to be found so that the details of the bare trust can be reported. And you need the trust information when registering for a trust account number. So another reason that the trust agreement is needed. And what's the incentive to file these T3 returns? Well, there's unfortunately significant penalties if the returns are not filed or if they're filed late. So the standard penalty is $25 a day to a maximum of $2,500 if filed late. And if you don't file, there's a failure to file penalty of the greater of 5% of the maximum value of the property or $2,500. So if there was a property that was worth $1 million, 5% of that is significant if there's no trust return that's filed. There are exemptions to the new trust reporting requirements. Trusts that have not existed or that have only existed for 3 months are exempt. Trusts that have assets with a fair market value of $50,000 or less throughout the year. So I know I've already had some clients who have been exempt because of this. Some smaller assets that are owned technically in the company, but legally owned by the individuals. There's also trusts that are required by law or under professional conduct rules to hold. So generally this is lawyers' general trust accounts. Registered charities are exempt, as well as not-for-profit societies, clubs, and associations, and then mutual trust funds are also exempt. So yeah, that's the summary of the new trust reporting requirements. I think really the one that likely would stand out to most individuals is situations where parents or even business partners might be on title with somebody else on a property. You might have a bare trust arrangement in that scenario. So the next topic, and almost my final topic, is underused housing tax returns. So this is another one that was recently introduced by the CRA and has been applicable to, again, many clients and more than I think the CRA might have intentioned originally when the new legislation was created. So this tax was introduced last year, so it's something that you might have already heard talked about. UHT, what is it? It's a new tax and filing requirement that was originally aimed at non-residents who own residential property in Canada as of December 31, 2022. But unfortunately, this has resulted in many Canadian individuals and corporations that had to file a UHT return. The UHT is a 1% tax on the taxable value of certain residential properties. And it applied to residential properties such as detached homes or similar buildings, dwellings with no more than 3 units or semi-detached houses, townhouse units, residential condominiums, or similar. And if affected, there are some exemptions that may be available, resulting in no taxes payable, but still a filing requirement for that UHT return. So who needs to file a UHT return? Anyone who owns property, any non-resident that owns residential property in Canada had to file a UHT return. Canadian private corporations that owned residential property in Canada have to file UHT returns. Any partnership, including individuals who own properties as partnerships in Canada, had to file a UHT return. Trusts and trustees, and then any other owner except those that are excluded owners, which I will touch on. So who is an excluded owner? Excluded owners do not have to file UHT returns, and those include individuals that are Canadian citizens or permanent residents of Canada. So for example, myself, I own a home in Canada. I did not have to file a UHT return. Registered charities do not have to file. Cooperative housing corporations, Indigenous governing bodies or corporations owned by Indigenous governing bodies, municipalities or corporations owned by municipalities, and finally, corporations that are incorporated under the laws of Canada or the province, and the shares are listed on a Canadian stock exchange. Unfortunately, this did not apply to private corporations. So many Canadians who own companies or corporations in Canada and that owned residential property are impacted by these UHT returns and had to file UHT returns last year. The filing deadline initially for the 2022 UHT returns was April 30th, 2023. That deadline was extended to April 30th, 2024 for 22 returns. And the minimum penalty for not filing or for missing that deadline is $5,000 for individuals and $10,000 for corporations. So obviously this is a significant penalty if this UHT deadline is missed. And I know in talking to clients that we worked with on filing their UHT returns last year, a lot of people didn't even know about this. And I think there's probably still a lot of people who don't know. There are some proposed changes that have not yet come into effect, but I think they're expected to hopefully come into effect any day here. The federal government did propose some changes to expand the definition of an excluded owner to include specified Canadian corporations, assuming there's less than 10% ownership. So this would be a good thing for Canadian corporations that are owned by Canadian individuals who were unfortunately impacted by this, with filing requirements for UHT. Trustees of specified Canadian trusts, partners of specified Canadian partnerships, and if these proposed changes go through, it'll eliminate the need to file UHT returns for these new expanded owners. They're also proposing to reduce the late filing penalties to $1,000 for individuals and $2,000 for corporations. So a little bit less of a hit in terms of penalties. And the proposed effective date for this would be January 1, 2023. So it would impact the filing requirements for December 31, 2023, if they're approved. So hoping to hear about this one any day here. And then finally here, I'll touch on the BC speculation tax. It's in some ways a little bit similar to UHT, but probably a little bit more applicable to people that are here tonight. So the new annual tax was introduced to vacant homes in an attempt to target vacant homes to turn them into long-term rentals or residential properties in an attempt to address the housing crisis in BC. It does target both Canadian owners and foreign owners. And the tax applies to certain areas in BC on the Lower Mainland, as well as on Vancouver Island and the Okanagan. There were some additional areas added in late 2023 that would be applicable for 2024. These were in Vernon, Penticton, Courtenay, Parksville, Salmon Arm, and Kamloops. So very much regions that are close by and likely affected by many individuals. And the tax rate for the BC speculation tax is 0.5% for Canadians and 2% for foreign owners. It might sound small, but really when you apply that to the value of a property, it definitely adds up. And the residential property owners in designated taxable regions are required to file or are required to complete an annual declaration and claim exemptions if they are exempt from the tax. So the exemptions that exist for people that own property in the designated regions, I've listed them here. Obviously, the most common one will be the principal residence exemption. If there's certain other exemptions for principal residents, including if there was an individual who was in residential care, if they had a medical absence or a disability in which they couldn't be in their home, if there's a spousal separation. There's also an additional one-time principal residence exemption for BC residents, even if it's not their principal residence. There's certain rental exemptions. So if it's a long-term rental unit, you do not have to pay the tax. There's also exemptions for hazardous or damaged property. So if there was a fire in the property or the property was uninhabitable for another reason. There's medical and a medical exemption, year of acquisition exemption, spousal separation, bankruptcy, death, licensed daycare, or if it's a strata accommodation unit. And then there's a few additional exemptions for charities, cooperatives, municipalities, and First Nations. So that brings me to the end of my presentation. Hopefully it was helpful for you and helped you kind of brainstorm how you can start getting ready for tax season and hopefully bring to light some important areas of changes in the tax world. And I'm happy to take any questions if anyone has any.
That was great. Thank you, Gabby. Yeah, I made a lot of notes, and I know that my questions are going to be more complex than what we want to cover on our meeting tonight. But yeah, some of the things that we are now filing, right? Like just the amount of filing that's created. You're not necessarily going to have to pay tax on it, but you have to file it. Like it's data collection and it's, let's see what we can gather information on here so that we can be prepared to tax you in the future.
Yeah, that's a really good point. And it's really what's been, I think, most frustrating for us as accountants, just the administrative burden for so many taxpayers, even though they don't have to actually pay tax a lot of the time on the UHT or the speculation tax. They're now having to pay their accountant to file those returns and just deal with that extra burden. So it's been, like I said, quite disappointing and hitting Canadians.
Yeah. more costs, more paperwork, more administration, more time. You know, one of the things that I think all of us have noticed, I mean, just getting a mortgage on a property, the length of time that it takes, if it's not just a cookie cutter property. I mean, we just got a commercial mortgage. Actually, no, we ended up getting a residential mortgage on a fourplex in Esquimalt. And just because of where the market is, it took 6 months. It took 6 months to get a mortgage. And it just like the time and the energy that people have to put into all of this government bureaucracy. I mean, you know, it's just, I think we're all reaching our paperwork limit. So it's going to be really interesting to see what goes away or what gets worse in the next couple of years, and how this is going to impact you know, policy changes that other potential leaders might be talking about bringing in, because I know a lot of people are getting really fed up with all of the paperwork. And so, well, you know, how do you change that? You vote, right? You vote for someone who's got a better policy, and I think we're all struggling with that right now. So who do we vote for in BC and Canada? You know, what's going to solve the problem? And I know most of what we talked about tonight was BC and some general, obviously Canada related. But I know that you do work with some out of province clients as well. So we do have lots of people in Alberta, and quite a few people in Ontario as well. And of course, we never want to forget Darlene way out on the East Coast in Moncton. And yeah, it's just going to be interesting to hear all of the stories after tax filing. So my birthday is actually April 30th. So I'm tax file day. So I've never once filed my taxes on my birthday. So
Good thing you're not an accountant.
yeah. So there we go. Inga, you've got your hand up. If you've got a question.
Yeah, I was just wondering, thank you for the presentation, Gabby. The last tax, the speculation tax, so I think you gave the percentage for the tax itself, but what about the penalty for late filing? Did you mention that? Did I miss that?
I didn't mention that, and that's a really great question. Let me have a look quickly here.
So the late penalty for filing late with your speculation tax. So it's going to be interesting to see with all of these changes, are they actually going to impose some of these late penalties, or are they just going to be, because some of them I think they've already extended, right? Like one was
the UHT was
UHT.
extended. Yeah, and it's we've been wondering about that as well, as we've seen all these changes roll out. We've definitely been asking ourselves if there'll be some exemptions, or if they'll really come down with the penalties. I know the BC tax is specific to the province of BC, the provincial tax. UHT is a federal tax, so to the CRA. And I know just in the last little while, we've seen the CRA definitely not being lenient with penalties, and actually being quite hard hitting with penalties. So I'd be surprised if there's any leniency on the UHT side.
Okay, so I have to just share UHT. I don't know if we use the term here, but in Australia, when I lived in Australia, ultra heated, what was it? Ultra heated. It's a particular type of milk, ultra heated treatment or something. And so whenever I hear UHT, I think of my time in Australia with ultra heat treated. That was it. UHT, ultra heat treated. It's just like, I can't say UHT without thinking of Australian milk.
Yeah. That's funny. And I do have an answer to that question. Sorry for the
yeah.
So the late filing penalty on the BC speculation tax is 10% of unpaid tax plus interest at the prescribed rates, and prescribed rates are quite high right now. I know for the CRA they're around 10% they're charging now. So that's on unpaid taxes as well as on the penalty amount from the date that the tax was payable. And the penalty for failure to provide the required information in a declaration. So even if you don't owe any tax, you will have a penalty for that. And it'll the greater of $100 or $25 for each day where the failure to file continued, to a maximum of $2,500. So those are fairly significant penalties for even just missing that declaration.
Those are big penalties, big taxes, and it just feels like we're getting gouged at every corner. Wow. I know there were a few people who had mentioned things like selling properties last year, like pre-sale properties or condos, and they hadn't submitted the GST right at the time of sale. And so they were asking, well, can you submit in the year of, or can you submit with your regular taxes? I'm like, that's a good question to ask for tonight. So if someone sold a condo last year and it was subject to GST, and your lawyer kind of collected the GST and said, you've got to pay this, it's been paid out, you've got to pay it. Because a lot of us, right? A lot of people, just normal people walking around, don't have a GST number. And again, I had people calling me saying, well, I've been trying to phone the GST number and I don't even know who I'm supposed to call to get a GST number. So it's one of those things that it's kind of like compounding. It's like, you've got to get a number, you don't know how to get the number. You're trying to get through to the office to get the number. And if you don't pay it, you're going to be subject to fine. So it's like one of those catch-22s. But is there any particular deadline that you have to pay the GST on the sale of a taxable property? Or is it just like right away upon sale?
That's a really interesting question too, because if you're engaged in building and selling a house or whatever, and there's GST on it, or condo, whatever, you should be a registrant to start off. Because so for GST, there's a small supplier $30,000 of taxable income. If you're below that, it's optional to be a GST registrant. But if you're selling goods greater than $30,000, you should be a registrant. So you should apply for a GST number. They will backdate it if necessary, because you've charged that to your buyer. And then those GST returns, you can opt to have them as an annual filing, possibly, depending on the amounts. Yeah, it's sort of specific to each case, but
yeah,
my dog is barking.
That's okay. It's all good.
But yeah, so you should get a GST number, talk to your accountant. You can kind of plan what your period is. It could be a year out from the sale, potentially.
Okay.
Yeah, up to a year.
Good. That's good to know, because as I say, I know there were a couple people who, had asked that kind of question. And yeah, again, not necessarily having all the specifics. It's one of those things where everything is slightly different, and no such animal is the same. So depending on what you're actually doing and what you've sold and what was taxable, it's going to be specific to each situation. But yeah, I'm sure that whoever that was, I'm sure I made note of it in my book. I'll get them to give you a call and give you some more specifics.
Yeah, I also had a situation a couple of years ago where a fellow had land, and he was not a GST registrant for a long time, or for the whole time he owned the property, but he ended up selling land that had GST applicable on it. And it was sort of, well, it was stupid. CRA provides guidance on what to do in those cases where maybe you aren't a GST registrant. It says remit on this form to CRA. We did that, and we only got questions back from CRA because, I don't know what department it ended up at, or some junior CRA person. She didn't know what to do with it. She didn't have an account to apply it to.
Yeah.
So I'm like, I said, but it says right on your form, use this form, it's on the website, use this form. And it was a bit of a pain. I think in the end, we had to set up a GST number just so the CRA person can process it somehow.
Yeah.
So it was set up and then promptly closed shortly after.
Oh, joy.
Yeah.
Ah. Well, I sure am glad that we have good, competent people who are looking after accounts for us, because we all know that nobody wants me to do their accounting. That's for sure. And yes, I'm looking forward. I think this year is actually my catch up year, so I'm feeling good about finally catching up on some things that have been a little bit behind. So there's my that's my story. I'm sticking to it.
I was also gonna mention that we do from time to time send out email blasts, obviously to all our clients, but if you want to be on our email list to be informed about these new taxes, UHT or the new trust filing thing requirements, send us your email. We can add you to our email list.
Yeah, and we're happy to put some of those things in the WREN newsletter as well. We've been pretty good at sending that out almost weekly now. And so obviously we like to share information from our partners and sponsors. So we're always happy to put some items in there. And I think we also, there was talk about, you've got a what was it at the beginning? There was some kind of a checklist. I'm like, oh, that would be perfect.
Worksheet.
The rental worksheet. Yeah, we'd love to get that. That would be
Yeah.
great. Because every, it's again, like being someone who has partners when we have lots of different properties, and I'm never the accountant, right? I somehow always end up pitching in or helping out or getting things started, but everybody who ends up, taking on the books for whichever project, they all have a different method, and so some are spreadsheets, some are QuickBooks, some are they've got the right tax breakdown with GST and PST for every expense. Others, it's, the shoebox method. And so having something that we can share, from WREN and say, hey, this is what we're using with our accounting partners, then that might also give people something else that looks nice and clean and tidy, because we have literally, I don't know, probably I think I've seen 10 different worksheets and styles and methods just in our little group, vertical and horizontal. And I'm like, wow, that is the craziest thing I've ever seen. So yeah.
But we try to keep them pretty simple. They're just PDF. It's kind of a list of usual expenses that you would include. And just as a rule of thumb, when you're considering rental expenses, or even business expenses for that matter, is any expense incurred that helps you earn that income. So we're not limited to just the types of items on that worksheet. It could be other things that you might not have thought about. So keep that in mind, always in the back of your mind. Does this help me earn that income? You might be able to deduct that, talk to your accountant about it, and they can confirm if that is the case.
Cool. This is great. Anybody have any more questions? A great presentation, by the way, Gabby. That was fabulous. It was just really good to get that kind of drilled into us, right? The UHT, the speculation tax, the changes that are coming, the principal residence, the Bear Trust. I mean, we've got a Bear Trust, and I think I mentioned in the notes with co-ownership and co-housing, we've got Bear Trusts, and I think we've got at least 3 that we have as Bear Trusts. So it'll be interesting to go back and check what all of those look like. Filing, not necessarily paying tax, but filing, right? More paperwork.
Exactly,
Yeah. Painful. Email address for a newsletter. Yep. Awesome. Lots of people said, yeah, good. They've got some good information. So yeah, if anybody has any last questions for Gabby or Karen, feel free. We won't put your questions in the recording, so don't worry if you have a question that you're, that you either think is a stupid question, because remember, there's no stupid questions, not in our group. It's all a learning curve, and things are just changing too fast. Like how can we keep up? Like we can't be expected to keep up with the way things are changing, because a lot of the professionals can't even keep up. You know, you call your lawyer and your accountant, and you're all, in some cases, you're learning of these new things together. You know, they're
Yeah.
through an announcement at the Globe and Mail, you know,
Well,
in the news.
and even ourselves, like last year when it was like in January that they announced the UHT filing, and there is very little guidance on what about this situation, what about that situation, does this apply? So it was like, you know, all the way up until that first filing deadline, which I think it was March or April, I can't remember now, because they extended it to October, then they extended it again. So, you know, it was sort of ever evolving, or the information, the guidance, the details, you know, it's very frustrating.
Yeah.
And for accountants who, you know, between February and April is already some of our busiest times of year, with filing T4s and T5s. We're doing all of that right now, a lot of work. We were already filing some trusts, the family trusts, at the end of March. Now add on the new bear trust, that there's so many out there, you know, very innocent, you know, in tax planning arrangements. It's just for succession planning or helping your kids out, or, you know, it was just easier to do this way. And, you know, didn't matter a year ago, but now it matters, you know, so it's very frustrating. But
yeah, it's frustrating when the policies are decided before they've got all the process that goes with the policy, right? So in that, we just see that happening time and time again. And oftentimes in these kinds of situations, it involves your lawyer and your accountant and you know, a few other key people on your team. And we're all, as I say, we're all kind of learning it together. And yeah, you kind of look through the policy and you realize half the process is missing, you know.
Yep.
So it's
so
yeah.
At our office, we have a designated person who is like managing all our UHT, all our bear trust filings, so that, you know, she's kind of learning it all. And, you know, there's just more efficiency in doing it that way. She manages them all. She's getting all up to speed on all the information. And so it works well at our firm anyways, to do it that way.
Yeah.
And so if anyone has any questions, feel free to reach out to Gabby or myself, and we'll help you navigate your particular situation. Everyone's different.
Sounds awesome. Sounds great,
Yeah.
Karen and Gabby, and I'm sure we're going to see you again when we pop up. I think we're kind of targeting end of April for another trip up to visit you guys, and so we'll hopefully decide on that in the next, maybe in the next 10 days. We'll confirm with Dawn, and he threatened to have some of us over for a barbecue if we came back up again, so we're going to take him up on that. So
well, that's good.
yeah.
Weren't those modular homes something else?
Oh, amazing. So yeah, if you haven't been over to Vancouver Island and joined us for Dawn Cameron's showroom, Dawn is one of our WREN sponsors and partners, and we've known Dawn. He's partnered with a couple of the ladies in our group and outside of our group, and I guess we've known him now. It's got to be 3 or 4 years, I think. And he's got a great family business, and he's got these incredible modular homes that he built. And we went to the modular factory to see where they were built, and we went to the showroom and we had lunch together, and it was just a great day. And there was a busload of us. So I think there were 20, let's just say 20 for numbers. And the end of the day was the wine tasting, and we could barely get people out of the factory showroom to go to the wine tasting because they were so fascinated with Dawn's whole factory and the processes. And, you know, we went into one that was just starting and one that was just finishing, and we went into one that's like a 6-story condo building that's being built in pieces on site. Just incredible. And it's just such a way more efficient way to build housing, especially in a country like Canada where you've got rain and snow everything should just be built undercover and shipped and put up on, you know, in 2 or 3 days. So we know that it's getting more and more that way. And yeah, I can't wait to, we've got something in mind with what we're going to build with Dawn. So it's going to be a little ways down the track, but it's going to be, yeah, we're hoping that we can bring him on board for something that we've got planned. So there we go. So fantastic. So ladies, if you've got any more questions, we've got about 5 minutes left. Couple of things just while, if anybody wants to unmute and jump in, but a couple of things while we're just thinking about what our last questions are. March 23rd. We're just finalizing the details. We're going to likely be doing a full day event in Vancouver at the Keller Williams office that we were at last September. Really great location, kind of in the middle of Vancouver. There's an awesome Greek restaurant across the way. So we're going to kind of have a full day staging, accounting market update, or sorry, mortgage market update. Probably renovation, I said staging because, you know, people are going to be selling the homes this year, so they're going to want to push as much as they can get in this market. Possibly Jory might be there to update us if there's any major CMHC changes, and, you know, some of the usual stuff that we talk about. Julia or one of her partners might be there to give us an update on the Alberta market, and then we're all going to go across for like a happy hour at the Greek restaurant. It's a really, really good Greek restaurant. So that's going to be Saturday, March 21st. And as I say, we'll have the details. And then April 26th, 27th, we're targeting for going back up to Dawn. So Dawn and Karen and Gabby and Chelsea and I will all chat next week and just see what the possibilities of that are. If April's too soon, we can push it a little bit into May. The Pacific West Conference, which I know isn't until October, but they have announced their dates, October 1st, 2nd, and 3rd. It was the best real estate conference I've ever been to. It was so well done. And it was put on jointly by the Vancouver Real Estate Board and the Fraser Valley Real Estate Board. And they loved doing it together so much that they are doing it again this year, and it's bigger and better. And I'm emceeing again, so I'm excited. I'll be there for 3 days. So I'd highly recommend putting that on your calendar if you want to network, if you want to learn more about real estate. It was really powerful, and they did a lot. They probably did a total of, they had 5 or 6 keynote speakers, and the keynote speakers did mindset and, you know, all kinds of things that were outside of, you know, the real estate processes per se. But between all of the breakout sessions that they had and the fireside chats, I think they did about 30 sessions. So it was well worth the money. It was only like $400. So it was well worth the money, and really, really good. So I'd put that on your calendar for a good real estate event to go to this year. Of course, we have been bringing back Members Connect. So we're going with the last Thursday of each month, and we're just getting our members to tell us what he's struggling with, what do you need help with, what are you succeeding at, what do you want to share, what do you need partners with. I might have a little Mexico beachfront property that I'll be looking for partners with. It's pretty exciting, I gotta say. We'll talk more about that once I'm meeting with the owners on Friday. And then, of course, we're continuing with monthly momentum, which is the 3rd Wednesday of each month. We'll do happy hours. We're going to switch now a little bit between doing a happy hour and doing a kind of an educational session. So you'll see that coming. We'll get those started again March or April. And I think that's probably the highlights for live events. I think if you're a member, you've probably seen that you have access to our new course, Start Here with Real Estate. We've moved it over to the Kajabi platform, which I have to tell you, for any of you who have like had a business and moved the entire thing over to a different platform, it really sucks. Like it's shit. There's no other way I can say it. It's shitty, especially when, you know, you've got an organization like Kajabi, which I love, but oh, you can get up and running in a day. No, you cannot. They're lying to you. You cannot get up and running in a day. It's impossible. So we're happy with what we have now, and I'm probably going to ask Karen permission to share that rental checklist on there, because that'll be good for people who are looking to take that Start Here course as well. We had it on the WREN dashboard, but we've upgraded it, added a ton to it, got more videos and more things that we've added to it, and it's on Kajabi. And then if people are looking to take it, buy it, we've got it on sale right now for 50% off, so it's like $49.95. So if you need any information about that, let me know. And many of you have also been asking about coaching, so we are launching the coaching program very soon. It's probably going to be the end of March. And I'll be announcing who the coaches are going to be joining me very soon, and we'll get those dates worked out and give you a lot more detail on that as well. But a lot of people have been asking more about the multifamily, the collaborative way that we do our real estate investing, the economies of scale of buying an 8-unit apartment building versus buying a condo, and how do you do that? So we're going to be coaching through that with a good group of people. So that's mostly the update from me. And yes, I'm still in Mexico. And yes, I am looking at a beachfront boutique hotel. And it is pretty spectacular. And I think you've probably heard me say the economy in Mexico is just booming. And I think we have a window to get in before it becomes too expensive. Mexico has been just all over the news. I think recently Puerto Vallarta in particular, which is where I am, has become one of the top 3 global destinations. Like Italy, I think there's 2 cities in Italy, and Puerto Vallarta was like somewhere 4th or 5th. So you would never have thought that 5 or 6 years ago, right? Oh, top destination in the world. Rome, second destination, Puerto Vallarta, Mexico, but it's really become that popular, and the developers have really started doing a lot more sustainable development. And yeah, it's just been really interesting to be down here for an extended period of time. And I've been coming down for about 5 years now, and each time I come down, I extend my stay, I meet more people. And the lifestyle down here is just, you just can't compare it. People are healthy and happy and smiling all the time, and the Mexican middle class is growing. So again, a lot of you have heard me talk about that. Like, I don't want to be part of a place where you just go in and you're those foreigners who buy up all the homes and you're displacing people. But the Mexican middle class is really growing. So it used to be that when you would go to nice restaurants, you'd see a very, very, very small proportion that was Mexican, and now it's easily 50%, in some even more. So it's really good to see the Mexican middle class growing, and the middle class benefiting from the economy that Mexico has got going on right now. So I could talk about it all night, and I probably will in a couple weeks when we've got a little bit more information and I make a decision on this property. But it's really cool. And I think if you haven't seen it, I've got it posted in a couple places, so you can let me know if you want to have a look. And it's 7:30. We always do this. We finish like right on time. So there we go. We had an hour and a half. It was great to see everybody, and awesome to hear our tax tips to get us in that mindset.